Good afternoon or good morning if you're joining us from the West Coast today. Thank you for joining me and welcome to the Equifax Canada Quarterly Business Credit Trends. Also, happy first day of spring, everyone. Hopefully, many of you had some downtime last week if you took time off for the March break. And if you didn't, hopefully the office was a bit quieter for you. I'm Sinead Gleason, Business Solutions Product Lead here at Equifax. And today I will lead us all through a look back at the fourth quarter of 2023. Before we get started, I'm going to pass things over to my colleague Sandra, who's going to walk us through a few housekeeping items. Sandra?
Thanks very much, Sinead, and good afternoon, everyone. Each area within the On24 webinar platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the media player, so feel free to enter any questions you may have, and we'll try and address them throughout our session today. In the event there's too many questions to get through, we will reach out to you individually to follow up in the coming weeks. Our presentation, as well as some related content in English and French, are available for download in the related content area. Our session is being recorded, and you'll receive the on-demand link via email tomorrow. We'll also have some polling questions today, so keep an eye out for those. You can provide your answers right within the platform by selecting the appropriate option. Some additional features you'll notice on the bottom of your screen are reactions, let us know how we're doing, our survey, and contact us. Feel free to check any of these out and provide your feedback. We really appreciate it. Now let's get started. Sinead, back over to you.
Thank you, Sandra. Okay, so as we typically do, we will start with a high-level review of key economic indicators affecting Canadian businesses last quarter to set the stage for the credit trends that we're then going to dive deeper into. And if you joined us on March 7th for our Consumer Trends webinar, you'll recall that we noted that consumers were experiencing a hard soft landing. You know, on the whole, the economic environment looked favorable. However, when we looked at that through the lens of population growth, per capita measures were down. There were more jobs available, but looking at the employment numbers with rising population volumes, we see a drop in the employment to population ratios. Consumers in Canada are feeling economic pressures, which will impact the way that they spend with Canadian businesses. The fourth quarter saw a return to positive GDP growth after 3 consecutive quarters of a shrinking economy. And we also saw retail sales tick higher. So people were spending more and paying more for those goods and services. On the surface, not a bad way for businesses to end the year. And then here we have the Consumer Price Index on the left-hand side for January 2024, and then the Industrial Price Index trend on your right. In the price index graph, we see that there was positive growth for all items, but not as strong as we'd seen the prior year. The growth of the overall CPI really was bolstered by those housing numbers in the middle of that graph there. And as the mom of a university-age student who's been hunting for a new apartment, and as the wife of an independent contractor whose customers are actually considering closing up shop because of rent hikes, I can attest to that housing rented accommodation growth number. It is absolutely brutal out there. But removing shelter and housing from the equation, consumers saw some relief in 2023, particularly at the pumps, it would appear. On the Industrial Price Index side, we see a slowing downtrend. After prices came down mid-2022 and into the start of 2023, midway through last year, we saw those costs begin to creep back up again. Labor costs reported a 5% increase, so all combined, businesses faced increased costs on all fronts, with labor being more expensive than pre-pandemic levels and prices rising since 2021, there's been considerable pressure on the cost of doing business in Canada. And then finally, the chapter on CEBA loans was sort of closed at the end of Q4. There were $49 billion in loans granted through the CEBA program to almost 900,000 businesses in total. And for the percentage that were not able to repay their loans by the deadline, they're now facing repayment loans with 5% interest per year. Now, it's somewhere in the range of about 250,000 businesses who are affected by that, which is an added financial obligation piling onto the amount of costs of doing business. Although many were able to secure loans to be able to take advantage of that forgiveness portion in time to help take a little bit of that pressure off. Okay, so now let's take a look at the fourth quarter credit trends and see how those factors played out. What we'll see emerge over the next 15 minutes or so are three key themes. Access to credit continues to be a challenge for many businesses. Rising interest rates continue to put pressure on both businesses and consumers, and delinquencies and insolvencies are on the rise. And we'll have the opportunity to hear from our speakers about insolvencies and bankruptcies during the panel portion of our session today. So make sure you stick around for that. New business openings ended stronger than what we'd seen last year, with 2023 posting 39,000 more new business openings. And that was fairly evenly spread across Canada, which you can see on the right-hand side of your screen, with the Western provinces reporting particularly strong growth numbers, as indicated by the gray bars. And compared to the pre-pandemic benchmark of 2019, which is shown in the red bars, there were declines, which were driven by both the Western provinces of Alberta and BC, as well as Ontario. So some nice rebounding happening there at the end of 2023, and hopefully we'll see that trend continue as we head into 2024. At the close of 2023, balances on financial trades reached $38.1 billion, an increase of 7.4% compared to the same period last year. These are the balances on the credit products that are issued by financial institutions as opposed to those supplier accounts, which are the business-to-business accounts. The financial trade balance increases were strongest in BC and Ontario. When we break the growth numbers down by sector, we see that it's being driven by finance and insurance, transportation and public utilities, as well as real estate and rental and leasing. In terms of whether or not those balances are being driven by older or newer accounts, it's stemming from those older accounts, some of which were opened during 2020 through 2022. Newer accounts were actually reporting lower origination amounts and outstanding balances. Okay, looking now at the credit demand, which is measured by inquiries on credit files. When we compare inquiries to the same period last year, so Q4 2023 to Q4 2022, demand for credit increased by 5.5%, particularly by those businesses with lower risk scores, which had double-digit growth. Compared to the previous quarter, however, the demand for credit amongst businesses with lower scores is significantly less. Growth has slowed, generally speaking, in the fourth quarter. And then looking regionally, compared to last year, we see that BC and Ontario are reporting the strongest increase in demand. But it's up nationally compared to where things were at prior to the pandemic, though. We're seeing double-digit declines in each province. Okay, what we're looking at on this slide are the number of new account openings in the stacked bar graph on your left. The gray stacks represent financial trades, so those are the banking ones, loans, lines of credit, and credit cards. And the red stacks are the industry trades, or those supplier accounts. And then once again, like we saw last quarter, we're seeing fewer new account openings. This is true for both industry and financial trades, suggesting that in spite of an increase in inquiries or credit demand, like we saw on the last slide, those inquiries are not translating into new accounts. Lenders are still being more cautious than they had been last year. In fact, 64% of new accounts were opened by businesses that were opened in the last 2 years. And lenders continue to be more inclined to open those accounts with businesses that are lower credit risk. Regionally, new trades are dropping in each province. On the supplier side, on the left of your screen, meaning those business-to-business accounts, Ontario really shows a softening in new account openings from the peak that we'd seen in the second quarter. But the trend is the same really for all provinces. On the banking side, to your right-hand side, the early rise that we saw in the first quarter has started to taper off for each subsequent across all provinces. With the CEBA deadline, behind us now, this might start to show a bit of a reversal when we get into the first quarter data, or when we get that first quarter data to show you, as businesses start to take advantage of loans to offset the forgiveness portion within the program. So it'll be interesting to see how that plays out next quarter. And then consistent with what you might have been seeing in the headlines, the bankruptcy and insolvency rates jumped in 2024 by 41% compared to last year, and now surpassed the numbers that we saw in 2019, sitting at 30% higher than pre-pandemic levels. And regionally, it's everywhere. While some of the provincial numbers are smaller, the percent increase is in the double digits, except for Alberta. BC was particularly notable with a 64% increase versus last year. And like I said earlier, our guests will be doing a deeper dive overview for us on the bankruptcy and insolvency landscape in a little bit. And if the delinquency rates are any indicator of those bankruptcy rates growing, then there does remain cause for concern here. You'll see that delinquency rates are on the rise for both industry and financial trades. Early stage delinquencies are those 30-day delinquencies on the supplier side. That's the blue line on your left. They're creeping up to about 11.5%. And on the right-hand side of the screen, the early stage delinquencies within the banking trades settle down at around 3.25%. And then looking again on the banking side, the late stage delinquencies indicated in red and yellow, they're on a pronounced rise. With the scale is small, yes, but the rate has grown to 8.5%, but it's the trend that is concerning there. Okay, so recapping the trends that we saw emerging, credit demand among higher risk businesses was up significantly compared to the same period last year, although that trend slowed down compared to the previous quarter. The growth of new accounts, however, was driven by lower risk businesses, which illustrates the continued tightening lending environment that played out throughout the course of 2023. And then lastly, the rise in delinquency rates and the double-digit growth of insolvencies shows that Canadian businesses are really showing their financial stress. Considering that Canadian consumers are also feeling pressure and spending less while owing more, their spending behavior will have a downstream impact on businesses. Those businesses that are a higher credit risk are potentially an underserved segment. And so are there strategies that can be implemented to both serve the needs of Canadian businesses broadly while ensuring healthy risk lending policies? It's definitely a challenging balancing act. Okay. So let's take a closer look now at some of those financial products. We'll examine lines of credit and cards and see two themes emerge. Growth of credit cards is stalling and utilization rates are growing. Okay, so let's get grounded on the data that we're looking at here. The line graph on your left presents the average balance on cards in the blue line and lines of credit in the red line. And on the right-hand side of your screen, it shows the number of new credit card accounts by quarter for the last 4 years. And what this shows us is that the growth in credit card balances that we've been watching all year netted out at about a 15% increase compared to the fourth quarter of 2022. Much more pronounced than the growth in balances on lines of credit. But we do see the trend starting to soften by December. And when you look at the account openings on the right-hand side, you'll see that 2022 was really a record high period for new account openings. That slowed back down in 2023. And so that leveling off in the average balance trend will be a combination of reduced level of limits on new cards, as well as a reduction in overall spending. So the optimism that 2022 expressed was very much tempered in 2023. Okay, and what has the payment situation been like on those cards? Well, you can see that the trend line in the dark red that represents early stage delinquencies, and it has been slowly creeping up. And same thing with the 90-day plus delinquencies, which are essentially those charge-offs. Those have reported a steady incline during the fourth quarter. We had data from January of this year, so we can see that delinquencies are up 7.4% compared to the start of 2023. Notably, real estate lending and leasing businesses have seen some of the largest annual increases in early delinquencies, rising at 6.2% annually. And because cards have been growing really strong for the last couple of years, that growth could have been masking some of the delinquency rates that we're going to be seeing going forward if January is any indication. So we'll have to keep our eyes on that. Okay, now we're looking at balances on lines of credit. Nationally, total outstanding balances on lines of credit was up by 6.8%, as Quebec and the Atlantic reported strong regional gains. When we look at average balance per business, which you'll see illustrated in the chart on your left, BC saw the largest growth rate at almost 20%, where the average balance per business, that's a mouthful, where the average balance per business is nearing $25,000. And like we saw with cards, the growth in new accounts really tapered off in that second and third quarters of 2023, illustrated in the bar graph on your right. We did see, too, that the biggest drop of new originations came from businesses with low credit scores. And like we saw with cards, delinquency rates on lines of credit also accelerated in 2023. It looked like that was softening in December, but we do see in January those rates tick back up again. In fact, the 30-plus day delinquency rate is 14.7% higher than it was at the start of 2023. Regionally, late-stage delinquencies in Quebec were up 14.7% compared to last year, and balances in BC have grown to 10.3% to $434 million. And then finally, let's now look at installment loans, where we'll see that the average origination amount was lower, but the number of new accounts grew as well. We'll see a continued steady drop in balances. And not to sound like a broken record, but the delinquencies are on the rise here too. Both early and late stage delinquency rates are up, indicated in the line graph on the left-hand side. By early stage delinquencies, the early stage delinquencies are now sitting at 4.1%, while late stage delinquencies have reached 3.4%. On your right-hand side, we're looking at the number of new accounts in the gray bars, which has been on a steady decline since May of 2023. And the red line represents the average loan amount. And that has been steadily dropping since the start of 2022 and now sits at about $102,000. Although new accounts have been dropping this year, the numbers are still up compared to the start of 2022. And perhaps unsurprisingly, the biggest drop that we saw this quarter for new account originations was on businesses with low credit scores, once again illustrating a higher degree of prudence by lenders. Okay, so do you remember the big takeaways from our financial product credit slides? Let's recap. Businesses are still using their credit cards, as we saw that credit card debt remains high from that strong growth period that we saw at the start of 2023. New card growth has stalled compared to 2022, but still remains higher than what we saw in 2020 and 2021. We saw the tightening of lending criteria impacting lines of credit as origination stalled. However, we did see some strong regional growth on balances on these products. The number of installment loans was on the decline too, with lower loan amounts. And then clear across the board on all products, delinquency rates were on an upward trajectory. So what can business lenders be thinking about in an environment of rising balances and delinquencies? Keep an eye on your accounts, watch for signs of stress that you might not see within your own portfolio. Score trends will give indications of how those businesses are managing outside of doing business with just you. Take a look at trends within the industries that those accounts are doing business in. Are there general trends in one sector over another that you need to pay more attention to? And if you're able to, helping businesses manage their overall cash flow and financial obligations with debt consolidation loans might be one way to help partner with your accounts to help get them through this period of economic strain. And with that, it's time to now hear from our guest speakers. As we saw in the slides earlier, bankruptcies have been increasing for businesses since the record lows that we saw during the pandemic. And so I'm very excited to introduce to you all today our guests. Joining me this afternoon are Miranda Killam and Alex McDougall. Miranda is the Superintendent of Regulatory Policy and Public Affairs at the Office of the Superintendent of Bankruptcy. Miranda oversees 4 teams at OSB: Policy and Regulatory Affairs, Licensing, and Communications and Outreach, and Operational Learning. She's currently leading a complex regulatory amendment project, and Miranda holds a law degree from the University of Ottawa. And then also joining us is Alex McDougall, who actually joined us about 1.5 years ago now. Alex is a senior analyst at Innovation, Science and Economic Development Canada. Alex works on marketplace framework policy and specializes in bankruptcy and insolvency policy. He holds a PhD from the University of Calgary. So Miranda and Alex, welcome. And you know what, Miranda, why don't I hand things over to you and we can go through your slides. And if you are on mute, you can take yourself off mute.
Sounds good. I'm here. Thanks, Sinead. And hello, everyone. I'm really happy to be here today to provide an overview of the insolvency system with a focus on the role of the OSB and the superintendent within it, but also touch on the roles and responsibilities of creditors in the system. I'll highlight some of the data trends that we're seeing, discuss some of the OSB's priorities, and share some key messages and reminders, and leave you with a few resources. So I'll get started here just with a bit of an overview of the insolvency system. Really in short, the objective is to promote investor and creditor confidence in the marketplace. The emphasis is on striking a balance between giving debtors with unmanageable debt a reasonable opportunity for financial recovery and ensuring that debtors and creditors share the burden of loss appropriately. In the commercial context, the insolvency system provides a framework for the orderly and fair distribution of assets when financial failures result in bankruptcy. And by facilitating, in appropriate circumstances, corporate restructuring and the redeployment of assets to productive use, the system contributes to efficiency in the marketplace and can help save jobs. In the personal insolvency context, insolvency laws play a really important socioeconomic role. Bankruptcy allows honest but unfortunate debtors who experience extreme financial difficulty to be relieved of their debts, subject to some conditions and exceptions, thereby giving them a fresh start. Insolvency laws provide a framework for individuals in appropriate circumstances to also seek an agreement with their creditors to repay all or some of what they owe, and this is called a proposal. The federal government has jurisdiction over bankruptcy and insolvency, and the key pieces of legislation noted there on the slide are the Bankruptcy and Insolvency Act, or the BIA, which governs bankruptcies, proposals, and receiverships for individuals and businesses. And there's the Companies Creditors Arrangement Act, also a mouthful, or we can call it the CCAA, and that applies to corporations with debts over $5 million. Both statutes are under the responsibility of the Minister of Innovation, Science and Economic Development Canada, or ISED. So the system is based on a relationship with 3 main stakeholders. We have debtors, who are the consumers and businesses that owe money, creditors, those who are owed money, and licensed insolvency trustees, or LITs. I'll call them LITs going forward. And these are private sector professionals that are licensed by the OSB to administer insolvencies. The court and the Office of the Superintendent of Bankruptcy also play an important role. I'll get into that in a minute. So the OSB is a federal regulatory organization within ISED, and we have 13 offices across Canada. And broadly speaking, the OSB protects the integrity of the insolvency system. We supervise the administration of all estates and matters to which the BIA applies, which includes receiving all insolvency filings. We also license individual and corporate LITs, maintain a public record of insolvency filings, record and respond to complaints, and ensure compliance by LIT state debtors and creditors. And where necessary, we undertake compliance or enforcement action. Back in 2009, the OSB was also given certain responsibilities under the CCAA, including responding to complaints against monitors and investigating when necessary, and also maintaining a public record of CCAA filings. The OSB also provides information to help debtors find the best option for their financial situation. We also disseminate information on insolvency so that stakeholders understand their rights and responsibilities and are better positioned to voluntarily comply with their statutory obligations. We also provide access to important insolvency data. The Superintendent of Bankruptcy is a Governor and Council appointee with a renewable term of 5 years and has statutory authorities and a quasi-judicial role pursuant to the BIA and CCAA. Elizabeth Lang is the current Superintendent of Bankruptcy. Sinead, you call me the Superintendent. I'm not quite the Superintendent. I'm the Deputy Superintendent, but thank you. Her term began in October 2018 and was renewed for another 5 years last October. And the legislation confers several powers to the Superintendent, who can delegate some of them. They're all listed, well, not all of them, but many of them are listed here, including granting licenses to LITs, as noted, making or causing to be made inquiries or investigations into estates and the conduct of LITs, issuing directives that have the force of law, and intervening in any matter or proceeding in court. I'll touch on a little bit here the role of and responsibility as creditors. So as noted earlier, creditors do play a really important role in the insolvency system. They have multiple roles and responsibilities, such as filing a proof of claim, to actually participate in the process, attend meeting of creditors, ask questions of debtors, vote on motions, give directions to the LIT, and they can examine the LIT's books and records. Creditors can also proceed where the LIT refuses to act. They can file a complaint with the OSB, oppose an individual bankrupt's discharge, and also oppose a LIT's discharge. And throughout the insolvency process, creditors do have some important responsibilities. They must comply with the provisions of the Bankruptcy and Insolvency Act, and that includes respecting any stay of proceedings. They must also file accurate proofs of claim, supported by documentation, and if appointed as inspector, be impartial and act for all creditors on the file. Now, before moving on to the next sort of segment, which is getting into some data and insolvency trends, I do want to take this opportunity to ask a question to the group, as Sandra noted. This is the sort of the poll. Just for some context, the OSB is currently reviewing one of our directives, Directive 23R, and it's called Publication in a Local Newspaper. And we're looking to modernize ways in which the notice of an ordinary bankruptcy gets published. So currently, publication is in a local newspaper. That's the requirement. So we're doing some targeted consultation right now and with creditors to better understand the best or preferred ways or mechanisms for creditors to get this information. So I believe if I go to the next slide, you'll see here the question, which is, in or through which communication platform or mechanism are you most likely to read about notices of bankruptcies? As in a newspaper, like a paper format that's in the locality of the debtor, newspaper, maybe a digital format in the locality of the debtor, an insolvency periodical, such as, CAREP's Rebuilding Success magazine, an industry or trade specific periodical, for example, that's something that's relevant to the bankrupt, mining, for example, or other. And if you have another suggestion, I encourage you to pop that in the chat. So I'll pause for a second, and I believe you can continue to look at this while I continue, but I may just wait 5 more seconds and then move on. And I thank you for your input. All right, I think I'm going to move on And maybe if we can come back to it. I'm not sure how that works, but just for the sake of time. Oh, we already have some polls that are in. That's excellent. Excellent. Thank you very much. All right, so now moving on to some insolvency trends, starting with consumer insolvencies. You can see in the graph that volumes were up a little in 2019, and then between 2020 and 2022, the total consumer insolvency volumes dipped and stayed below pre-pandemic levels. 2023's total volume of consumer insolvencies is comparable to pre-pandemic levels. And through 2023, the proposal to bankruptcy ratio, so the green compared to blue here, continued to trend toward a higher proportion of consumer proposals. So consumer proposals in 2023 totaled over 97,000, which is the highest single year total for consumer proposals. And that represented just under 79% of all consumer insolvencies. Now, our data shows that business insolvencies increased by a little over 41% in 2023 from the previous year, exceeding pre-pandemic levels after a significant fall in 2020, 2021. And this trend was already touched on by Sandra in the last presentation. But I will note that business insolvencies are a lagging indicator, meaning that current insolvency levels may not be predictive of future economic conditions, and that business insolvency trends are influenced by a number of macroeconomic, regional, and industry-specific factors. For example, changes in interest rates and borrowing costs, and issues affecting specific industries as well, like shifts in demand or supply chain constraints. And because insolvency trends are shaped by multiple factors, it is challenging to identify the precise cause of an increase in insolvency levels in a given year. I can also note that preliminary stats show that the CEBA loan, the Canada Emergency Business Account Loan, was listed as a creditor in more than 740 business insolvency filings in 2023. And in the first 2 months of 2024, CEBA was listed as a creditor in 304 filings. As for CCAA filings, we did see an increase in 2020 with a total of 60 filings, and that represented a 58% year-over-year increase. From 2020 to 2021, the volume decreased by 56%. And then in 2022, there were 39, similar to the pre-pandemic number of 38. And then last year, we did see the highest number of CCAA filings in a given year, with a total of 64 filings, and that represented a 64% year-over-year increase. For the sake of time, I may skip over the next few slides, but I would note a few quick things. The first one here is by quarter, insolvencies by quarter. It has stayed quite steady and consistent throughout, so there's nothing too noteworthy here. But in the next two slides, the key takeaway is that the recovery rate for unsecured creditors in proposals is consistently higher than the recovery rate in bankruptcies, and this is both in consumer and you'll see here in the next slide in business, in the business context as well. So I did skip over one I wanted to just highlight. Apologies for that. It's this one I wanted to speak to. And this is the last table here shows filings by the NAICS industry sector, so the North American Industry Classification System. And that's for 10 sectors, and this is since 2019. So in general, business insolvencies exceeded or at least returned to pre-pandemic volumes in 2023. And the three sectors that had the largest increases in the number of insolvencies were the accommodation and food services, retail trade, and construction. And no sector saw a decrease in the number of insolvencies in 2023 in comparison to 2022. All right, now I'm going to move on now to touch on some of OSB's priorities, and I'll try to highlight what I think is relevant for this group today. And these priorities will be featured in our annual business plan, which is expected to be published the first week of April. So first is our regulatory amendment work. We're undertaking a review of our directives, insolvency forms, and regulations under both the BIA and the CCAA. And this is to update, modernize, and streamline where possible. The regulatory work is a large project, as it does require a Treasury Board submission. I would like to note on the forms front that there will be a number of changes that come into force this upcoming July. And these include amendments to what's called the proof of claim So for those who know that, it's Form 31. But just to note that it's to simplify the listing of contact information of creditors and to allow creditors to provide information directly on the form that will help identify statute-barred liabilities. There'll also be some changes to the forms that will move the financial advice data from the assessment certificate to the statement of affairs. And that will ensure that creditors receive information on any financial advice fees that were paid within 6 months of the insolvency and any ongoing finance advice obligations that existed. In some cases, these ongoing financial advice obligations can amount to thousands of dollars. Some of the regulatory changes that we're also considering relate to LIT fees. And a subcomponent of this is looking at access to the system issues for low income and low asset and no income and no asset debtors. And you might hear the term LILA debtors, but also looking at micro and small and medium enterprises. Addressing issues in what some of you may have heard called the DAM, the Debt Advisory Marketplace, is another priority for the OSB, as this is an unregulated sector that operates in the gaps between the provincially regulated credit counselors and the federally regulated LITs. The OSB has been very active in this space and will continue to take a multi-pronged approach. We did issue a position paper in December to provide a comprehensive look at the issues and the concerns that arise when LITs have business relationships with unregulated debt advisors and or what we call lead generators. And we'll also be rolling out a plan very soon that's looking to proactively review LIT business practices that are based on analysis of patterns, trends, and publicly available information to detect and address non-compliance. We've also been issuing cease and desist letters to debt advisors that has proven to be quite effective in changing behavior. And we have several investigations underway pertaining to the debt advisory marketplace. Many stakeholders have submitted complaints to the OSB on this topic with detailed and actionable information, and we encourage others to do so as well. As creditors, I'd like to note a couple quick things here. Some debt advisors state or imply that they are LITs or could commence an insolvency proceeding on the debtor's behalf. But by relying on misrepresentations, debtors can end up paying for services that aren't necessary and duplicative of those that are provided by the LIT. And this is to the detriment of both the debtor's ability to pay, their financial rehabilitation, also the returns to creditors. The timing and structure of the costs that are associated with debt advisors generally mean that the debt advisor's fees are prioritized over the debtor's other creditors. And last, I want to note that the OSB is aware of instances where a debt advisor has encouraged debtors to charge the fees to their credit card, knowing that this debt will be included in the insolvency filing. The practice allows the debt advisor to get paid, but leaves the credit card issuers to absorb the debt. So I wanted to highlight that. So I'll just quickly touch on the others because I want to leave time for my colleague, Alex. On monitoring enforcement, just want to note that we are always looking to improve our capacity to effectively monitor and enforce noncompliance. And we look at expanding our use of artificial intelligence. And we're doing that now in the trustee compliance world. The use of AI has been successful in identifying high-risk files in the debtor compliance space. In the licensing side, we're doing lots of work to streamline some of our processes. We're also exploring cybersecurity minimum requirements and looking to develop guidelines this year for LITs to help safeguard the insolvency data they maintain. Just to note also, importantly, that increasing diversity, equity, and inclusion in the insolvency profession is an ongoing priority for us too. All right, I'm almost there. I just want to do a couple quick notes here, a few practice notes or reminders or key messages, if you will. The first point there is just a reminder of the importance of the statute of limitations and verifying the legality of claims. There was a recent decision in Eaton, I hope I'm pronouncing that right, and it did underscore that a statute-barred debt cannot constitute a provable claim in a bankruptcy. As previously noted, the OSB is amending our proof of claim form, and that will help identify statute-barred liabilities. It's also critical for creditors to respect the stay of proceeding as per the law, and I had mentioned that earlier. Regarding questions from debtors that are destined to credit bureaus, just wanted to note that the OSB does get inquiries often from debtors that are looking about possible errors in their credit rating. The OSB does not have any authority on this matter, so we do refer the debtors to speak directly to the credit bureaus. And two last points, just to keep an eye on our website for up-to-date information on stakeholder rights and responsibilities and updates on insolvency matters. In the next slide, you'll see there's lots of links that I can point you to. And if you see something, please say something. Creditors have a lot of power to help address compliance concerns or problems in the system. And I won't go through all of this, and I think this will be shared, but there is a lot of interesting and good resources on our website. I just highlight at the end there that there's the links to the online inquiries form as well as the online complaints form. And if you are submitting one, I ask you to provide as much detail and actionable information as possible. So I'll leave that there. Thank you for your time.
Great, thank you. And we will hand things over to Alex. That was extremely informative. Alex, thank you.
Thank you, Sinead. Thank you, Miranda. So what I wanted to talk about today is a little bit of kind of a deep dive into what I would say is a kind of overlooked element of marketplace trends. We tend often, it's based on a paper that I wrote and is published with co-author at Stats Canada. I think the full paper will be shared with the group if anyone wants to look in detail at the methods or the findings. I just want to go over some of the kind of high-level points of the paper, which I think might be of interest to this group. And in particular, the motivation behind our paper, it's really to understand the relationship between business exit and business insolvency or business failure. And the reason I think this is important is because quite often when we go through and hear about business insolvency or business bankruptcy statistics, there is some sense that the statistic, business bankruptcy or business insolvency, is capturing the kind of broader reality of business failure across Canada. However, it's important to keep in mind, and I think to caveat this intuition, with the idea that just because a business fails or exits does not necessarily mean that it becomes formally insolvent or formally bankrupt, and may not show up in the formal insolvency and bankruptcy statistics. And so we can kind of differentiate sort of, I guess, conceptually between the idea of a business insolvency, where there's a formal business bankruptcy or proposal filing or a receivership, and a business failure or exit, where the business exits the marketplace, ceases business activity for a variety of different reasons. Now, the statistic business bankruptcy or business exit or business insolvency is well reported. But the statistic on business exits and business failures that are not necessarily insolvency is not very well reported. In fact, we only know that it's a real statistic because of a data set maintained by Statistics Canada that uses tax information about employer businesses. And for that, we're able to see sort of what types of businesses open in a given year and when they start filing their employer tax information. And we can also, when they stop filing, see when they kind of go out of business or close. You might wonder, what is the, just as at a very high level, how many businesses that go out of business or fail, how many of those actually go into formal bankruptcy or an insolvency proceeding? And when I first learned this statistic, it was pretty shocking. In fact, only about 3 to 5% of all businesses that exit or fail do so through a kind of formal bankruptcy or insolvency process, which means that the vast, vast majority of business exits and failures are outside of bankruptcy, are not captured in a bankruptcy or insolvency statistic. We know quite a lot about formal bankruptcies and the characteristics of bankrupt businesses, in part because of the great work of my colleague Miranda and other colleagues at the OSB that have a lot of information about the financial information about bankruptcies themselves, in terms of trends, in terms of the types of businesses that go bankrupt, their financial characteristics, their employee profiles, the industries that are more affected. But we know very little, in fact, about kind of business exits more generally, which is the vast majority of business failures and business exits. We don't know that much about trends over time or about the profile of these businesses and how they interact with business insolvencies and business bankruptcies. And so that's kind of the motivation of this paper, is to sort of look at business exits and business failures and business insolvencies and bankruptcies, and to ask questions like, what type of businesses tend to use insolvency as opposed to kind of the more informal mechanisms of business exit and failure? How have business exit and insolvency trends changed over time? What factors tend to predict whether an exiting business uses insolvency or uses some sort of informal mechanism? How do these trends evolve with the COVID-19 pandemic? Of course, we saw a big decline in formal insolvencies, but how did the business exits look? And does that complicate our understanding of the pandemic situation? This as a kind of caveat as well, this paper is based on historical data. So we look between 2004 and 2021. And so we're not doing any forecasting here, unfortunately. But I think even though we don't have the forecasting ability with this data, or even quite as much real-time data on this question and these questions as perhaps we would like, it's still good, I think, to get a sense of the kind of landscape of the marketplace of business, the landscape of exits and failures, and how they look in comparison to insolvency. Furthermore, just looking at, we in this paper go into some kind of disaggregated data, knowing that the economy-wide sort of indicators of exit insolvency may mask what's happening in specific industries or in specific subsets of businesses. So, for example, during the pandemic, we know that smaller businesses were disproportionately impacted. And businesses in certain industries, such as arts, recreation, entertainment, were disproportionately impacted. So this paper, in addition to kind of looking at the broad trends of exit and insolvency, also tries to disaggregate a little bit and go into some of the subsets of the economy that may be of interest to some of the people on this call. This is only possible, the ability to look at the whole universe of insolvency and exit, because of some excellent work that I wish I could take credit for, but really is, I have to give credit to my colleagues at Stats Canada, who for the first time linked up our data on business exits using the CRA tax data with the OSB data on insolvency. And so this is really good because what it allows us to do is it's linked at the enterprise level. And so what this allows us to do is actually take any enterprise in the database from its creation going back to 2004 and then kind of see what happens to it. Does it continue on? Is it a continuing business? Does it exit for a variety of different reasons, or does it become insolvent? Does it file a proposal? And we can really then use this data set to look at the full landscape of business exits and business failures. Some exclusions in the data that I'll highlight as well. We focus just in this paper on incorporated business. So we take out unincorporated business, so individually owned businesses and sole proprietorships and that sort of thing. It's only employer businesses as well. So you have to have an employee to be captured. And we exclude some of the receivership data in bankruptcy as well from this. Those are some exclusions. And so using this newly linked database, our study presents a kind of a profile of business exit and business insolvency. This is a pretty simple paper in terms of the statistics as well. All we really set out to do, and what I'll do in this presentation, is just present some kind of high-level descriptive trends and kind of average characteristics. So even though I like high-powered econometrics and high-powered statistics, we don't really do anything that fancy in this paper. It's a pretty simple paper that really just sets out trends and averages and things like that. Just a couple of definitions. When we use the term business insolvency, or when I use the term business insolvency, I'll usually be referring to a business that has made a formal insolvency filing, either a proposal or a bankruptcy. There's also sometimes a kind of ad hoc definition of business insolvency where assets are less than liabilities, or a business can't make payments when they become due. Those are sometimes called insolvent businesses. But for the purpose of this discussion, when I say insolvency, it refers to a formal insolvency filing. I'll skip this one for a second. And when I refer to business exit, here, what I'm referring to is when a business ceases business activity for any reason and closes permanently. So this wouldn't be a temporary closure, but a kind of permanent closure. We can tell when businesses that have employers permanently close in our database. Unfortunately, the data doesn't really give us a sense of why the business closed or exited. Some of the literature, some of the economic and academic studies on business exit will differentiate between, for example, voluntary exit and involuntary exit. A voluntary exit would be for some idiosyncratic reason, the business that's solvent decides to close up. Perhaps the owner is retiring, or perhaps wants a change of career and decides to get out of the business, and then winds up or liquidates the business, but for a kind of voluntary reason. There's also involuntary exit, where the business is kind of forced to close due to financial circumstances. Unfortunately, the business exit data we have doesn't really give us a good way of understanding the causes of business exit or distinguishing between voluntary and involuntary exit. Now, just on the relationship between exit and insolvency, if you see a business bankruptcy, the business is liquidated, and it's an exit. So we'd say 100% of the time the business ceases activity, its assets are liquidated, and the proceeds are distributed to creditors. There's no more business. Voluntary exits might not be insolvent. And a proposal where a business that's in financial distress tries to make a restructuring deal with its creditors, the idea is actually not to exit, it's to continue the business as a going concern, resolve the insolvency, but actually stay in business. My expectation going into a paper looking at the difference between insolvencies and formal business bankruptcies and informal exits is that there would be kind of fundamental differences between the types of businesses that would choose to formally go bankrupt and those that would kind of just walk away and close the doors without a formal bankruptcy proceeding. I would expect just that insolvent businesses that go through a formal process would have a higher level of debt. That's kind of the point of the bankruptcy and insolvency process, is to resolve creditor claims against an insolvent business and distribute the assets in an orderly way. So if you didn't have a high level of debt, or maybe you didn't have a high number of unsecured creditors, that's another kind of function of the insolvency regime, is to help coordinate between unsecured creditors. If you just maybe had one secured creditor, that might predict an informal exit outside of bankruptcy. A business that didn't have a lot of marketable assets might also not be able to absorb the kind of the costs of a bankruptcy or an insolvency process. So the costs could be the filing fees or paying the insolvency trustee, that sort of thing. Therefore, I'd kind of expect the informal exits, those businesses that kind of go out of business involuntarily but without a formal insolvency, to be smaller businesses with lower debt, maybe less sophistication, maybe fewer unsecured creditors, and fewer marketable assets. That's kind of what we expected going in. So now I want to present some of the results that we found from looking at the data. The first set of results really is just about trends in exit and insolvency over this 2004 to 2021 period. The first trend that I'll point out is that if you go back to 2004, historically, there's this pretty strong correlation between business exit and insolvency. So like, for example, during the great financial crisis in 2008 to 2010, both insolvencies and exits went up, which is exactly what you'd expect, because all parts of the economy were sort of hit with the financial crisis. But then starting in around 2015 and really accelerating during the pandemic, we see a kind of interesting deviation from this historical trend, which is a kind of decoupling of exits and insolvencies. So what we see here is that exits, that's the green line here on the chart, exits kind of stay flat during 2015, and then they spike during the pandemic. Whereas formal business insolvencies and bankruptcies actually start going down in 2015. And then they plummet to actually historic lows during the pandemic. And so there's this decoupling that starts in 2015. And then during the pandemic, there's this kind of negative correlation. In fact, exits go way up, insolvencies go way down. So we found that was kind of interesting. I'll skip this one for a second and move on just to the characteristics of the different groups. So we kind of distinguished here between firms that exit and firms that go bankrupt. What we found was that they have completely different profiles in terms of the type of firm, in terms of the size of firm. So here we break down firm size into different groups. So for example, 1 to 9 employees would typically be considered a micro business. The sort of 10 to 99 would be a small business. And then 100 or more is a medium or large business. And what we see in the data is that the informal exit path, the kind of exit without a formal bankruptcy or insolvency process, it's quite frequent among these smaller and micro businesses, whereas it's quite rare among businesses that go bankrupt. Contrarily, larger businesses and larger small businesses, 50 up in employees, they're less likely to just exit informally and more likely to have a kind of a formal bankruptcy process. In addition, when we look across industry, corporations that are in the manufacturing sector have quite high bankruptcy rates compared to the general economy and relatively low informal exit rate. This might be because bankruptcy is a more viable option for manufacturing businesses. We hypothesize, although we don't really have data to back this up in this paper, that perhaps manufacturing businesses, they just have more marketable assets in terms of sort of sellable machinery, perhaps more creditors that have a broader kind of credit or interest in these types of businesses that make the insolvency process more viable. However, other types of businesses tend to exit informally, and those with maybe low amounts of that type of capital, such as arts, entertainment, recreation, that sort of thing, seem particularly likely to exit informally. Across Canada, we looked at different provinces. There was quite a lot of uniformity across Canada in these statistics, but Quebec is an outlier. It has a higher bankruptcy rate than the Canadian average. In fact, a much higher business bankruptcy rate than the Canadian average. Similarly, we didn't look at consumers, but I just know anecdotally that Quebec also has a higher consumer bankruptcy and insolvency rate than the Canadian average. But curiously, it actually has a lower exit rate. So it doesn't, I put these two statistics together and say perhaps it's not that Quebec businesses fail in higher numbers, but they do seem to utilize the formal insolvency process in higher numbers than in other parts of Canada. The final thing that we did in this paper was to kind of look at what financial characteristics predict an exit versus an insolvency filing. And we looked at 4 sets of financial characteristics, which are pretty common in some of this research and literature. We looked, for example, at leverage rates, so debt to asset ratios, how much debt relative to the assets does the company have. We looked at liquidity rates, so how much, which is kind of a rough approximation of the ability of companies to service their debt payments. We also looked at profitability, and we looked at labor productivity as financial characteristics. So the first is labor productivity. The technical measure is that we're sort of value added divided by the number of employees. And we find that the majority of business exits are among low labor productivity businesses. And this seems to be a consistent trend, including during the pandemic. However, bankruptcies are less likely to be in this lower labor productivity category, and they're more likely to be higher productivity businesses. However, even among high productivity businesses, bankruptcies fell during the pandemic. Profitability, we measure that by net income divided by assets. We find that a significant portion of the bankruptcies occur among companies that demonstrate low levels of profitability, which is a statistic that I think aligns with general expectations. However, fewer than half business exits were categorized under this low profitability category. Then we look at leverage. We find that leveraged businesses, those with a lot of leverage, are far more likely to use the formal insolvency process. And among exits, it's that the exit, the non-bankruptcy exit route is pursued primarily by businesses that don't have so much leverage. Similarly with liquidity, so the ability to service debts, we also find that a big predictor of bankruptcy, sort of compared to informal exit, is a low level of liquidity. So there's a big predictor of bankruptcy that you can't pay your debts. Whereas it seems like among exiting businesses outside of bankruptcy, there doesn't seem to be the same level of liquidity issues. So I won't go into any more detail on the statistics, but I will conclude with some kind of just general, I think, takeaways from this presentation. And of course, I invite you to explore the paper if you're interested in doing a deeper dive on any of these specific statistics. So the first takeaway is just kind of, I think, the high level awareness that is a large portion of business failure that is outside of formal insolvency, right? And in addition to that, this is an increasing part of the economy. So business bankruptcy has generally been declining, whereas informal exit has actually been increasing. So the bankruptcy statistic as a kind of general measure of business failure, I think maybe is less useful than it once was, at least according to this data, or at least it has to be qualified in some ways. In addition, I think looking at exits, particularly during the pandemic, really calls into question, I think, a common narrative that we have about what happened to businesses during the pandemic. So one of the common narrative, and it's, I think, based too much on the insolvency rate statistic, insolvencies went way down. So the narrative tends to say, well, there was creditor forbearance, and in addition, there were a lot of government supports. This sort of supported businesses during the pandemic. And so there wasn't as many insolvencies as we might otherwise have expected. But then when we look at the exit statistics, this really gets called into question because exits spike to really high levels. So it doesn't actually look like businesses were being kept afloat as much as maybe we like to tell ourselves, that quite a lot of them were failing. They just weren't failing through formal insolvency, and so they were being missed by the common statistic that was being used. For me, it's still a puzzle to be explained. We don't really get into a lot of the detail in this paper as to what's going on, what explains why there seemed to be a decline in insolvencies and increase in exits. That's perhaps a subject for future research. But it is something I think a puzzle just to highlight. In addition, I think it's also worthwhile to emphasize that the characteristics of businesses that go formally insolvent do, I think, fundamentally differ than businesses compared to businesses that informally exit in important ways. So generally, smaller firms are less likely to use formal bankruptcy. There are differences across industries. Manufacturing far more likely to use bankruptcies. There's some regional variation. Quebec seems to be a bit of a standout in terms of having higher bankruptcy rates and lower exit rates. In addition, businesses with lower levels of productivity, lower levels of profitability seem to go into informal exit, not so much into bankruptcy, but higher leverage businesses and businesses with liquidity problems tend to end in insolvency and not so much in business exit. So I realize I'm a little bit over time here, so I'll end there. And I don't know if we have time, but happy to take any questions on this or other topics.
Thank you so much. That's great, Alex. Thank you, Alex and Miranda. That was insanely informative, and I learned quite a lot. We are at time. We're a little bit over time, so what I will do is I will hold questions, and then we will review them. And if there's anything we can get back to you on in person, we will certainly do that. We will follow up. On behalf of Equifax Canada, I would like to express my sincere appreciation, Alex and Miranda, for joining us today and sharing your insights. Thanks also to my support team for helping pull this all together. And as always, thank you, audience, for joining and sharing your thumbs up and everything. We really appreciate it. And so with that, I'll let you guys go and have a wonderful rest of your day. Thanks very much. Bye.